Meanwhile, mortgage rates jumped to 7.9% last week, the highest since 2000. We are looking at 8% here. Rates rising 7 consecutive weeks in a row. We're also looking ahead to the September new home sales report that's out today at 10 a.m. Eastern. Economists are expecting sales of new single-family homes to be up 0.7% at 680,000 homes. September pending home sales also out tomorrow. Let's get into it with the Peebles Corporation founder, chairman, and CEO, Don Peebles, joining me right now. And Don, good to see you. Always a pleasure. I want you to assess the housing market for us after all these interest rate hikes by the Federal Reserve. And now we see the mortgage, 30-year mortgage, kissing up to 8%.
Well, you know, a couple things are happening. One, most Americans who wanted to buy a home or refinance a home have done that over the past 6 to 7 years. And what's happening now is many sellers are not willing to sell. So it's the fact that there is a lesser inventory because of that, and then interest rates are making housing less affordable, obviously, and then you have in the coastal states insurance as well. So I expect sales, prices and volume to kind of be stagnant. I think prices continue to hold because there's not much duress for sellers to sell, and I think that there's a lack of inventory even on the new construction side because of the remnants of COVID and a robust, 7 years before that.
I mean, look, refinancing is obviously not going to happen. If you have an incredible interest rate of a year or two ago at 3-4%, and now you're looking at 8%, why would you sell? Why would you get out of that mortgage right now, right? So are you looking at a little bit of a stalemate in the industry?
Absolutely, because actually now what's happened is that the mortgages at these low rates actually have value. We saw this in the late 1970s as well.
A new CBRE analysis finds that the average monthly new mortgage payment is 52% higher than the average apartment rent. The Wall Street Journal reports the last time the measure looked out of whack was before the 2008 housing crash. Even then, the premium peaked at 33% in the second quarter of 2007. Do you have tips on when to buy, when to wait, when to rent as mortgage rates continue to climb?
Well, look, if you're looking to buy right now and you see these statistics that it's 50+% more expensive to own than to rent, then you look to rent. And that's why we've seen rents go up so significantly. But apartment vacancies are actually increasing now, too. I think that pretty much people who made housing decisions have made them. You have the younger demographics who are forming homes now. Those are the ones, and they're not a whole bunch of them, but those are the ones who are looking to rent new apartments or buy new homes. And I would say that I would be renting for the foreseeable future, certainly through 2024, and then see what the presidential election looks like and what the horizon is for lower rates.
I mean, unfortunately, there's a little bit of sticker shock there as well, right? When we zero in and strategize and scrutinize, rather, the inflation data, it's the essentials that continue to be elevated. I'm talking about food, fuel, and shelter. So, yeah, renting is an option, but isn't that also an expensive one?
Very much so.
Yeah.
I mean, the Fed, by raising interest rates the way they did, had the opposite effect of controlling inflation because the biggest consumption product for consumers is shelter, and that's gone up significantly as a result.
So I know that you've got developments throughout the country, certainly in New York, in Florida, and elsewhere. Don, what is your assessment of the real estate market right now, and where do you see this going? Because these are not cycles that turn around overnight. These take a long time. And what you're saying today stays with us for how long? What's your outlook?
Well, I think that what's happened is that anyone who has bought an office building in the last market cycle has problems, or problems are waiting to happen. Anyone who's bought an apartment building at a 3.5% cap rate also has problems. But if you look right now, the way consumption is and occupancy is for office space, I mean, look, the federal government in D.C. is only occupying about 25% of their space on the busiest day. So you're going to see significant vacancy, significant stress, and ultimately the Fed begin to cancel some of these leases.
I see what you're saying. Yep, take a drink. I'm glad that you had your water right there, Don. But I guess what I'm looking for is how long these cycles will last. We're in a cycle right now where we're looking at interest rates put a bit of a shock into the market. How long can that go on?
Well, I think that it continues to go on because it just stymies the market. And I think wait until we get through 2024 and going into 2025, potentially with a new presidential policy, and I think you'll see changes.
What's the policy you're looking for to change?
Monetary policy. I think that the Treasury Department and the Fed has to begin to look at controlling inflation differently. And interest rates have made affordability for housing near impossible for most Americans now, and it's destroyed the commercial office market and is going to cause considerable problems in apartments. And those are going to create a lot of headwinds in our economy.
Yeah, I mean, are you surprised we haven't seen a breakdown in commercial real estate be real obvious? I mean, we've been talking about this coming for a while.
Yes, and I'm not surprised because what's happening is that the problem is so big that the lenders have to try to hope and pray that things get better. So they're kicking the can down the road because they don't want these properties back.
Wow.
But you're going to see more and more investors give their properties back to the senior lenders. And that's beginning to happen now. It's happened over the last 2 quarters, and it'll keep happening. Important information that you're giving us. Don, it's good to see you. Thanks very much. Thank you for being here. Thank you.